So have you ever taken a trade where as soon as you get into the trade, the market goes against you? So it's almost like somebody's waiting there for you to pull the trigger. And as soon as you pull the trigger, if you bought the market, they will then sell, or if you sold the market, they will then buy. And it literally just pushes your trade. Your trade doesn't see any daylight whatsoever, and it goes against you, and you kind of obviously end up taking a loss. Well, if you've experienced that before, there's something, first of all, that all of us traders have experienced. So there's nothing, it doesn't make you unique or, particularly unlucky or anything like that. It just means that you are in the trading market. And this can happen, particularly if you're trading at points of support and resistance or key inflection points in the market. You are going to get those times when you take a trade and it just kind of goes against you, because that's the nature of, trading professionally and trading consistently. If you're trading the right way, that is going to happen. However, there are other times when you can completely avoid these types of trades. So what day traders tend to do is that they will find a system and then they will kind of follow that system. So it doesn't matter what else is going on in the markets. If the strategy says take the trade, they take the trade. And what they don't do is they don't broaden their horizons that little bit and kind of look at the overall context of the market before taking the trade. And one of those things is looking at the range that the market has gone for that particular day, because looking at something as simple as the average true range of a market can actually help you, first of all, avoid losing trades, so not get into trades that you shouldn't be taking, but also adds a whole new string to your bow because it gives you a different way of getting into the markets and a different way of profiting from the markets. So in this video right here, I'm going to jump over to some charts, and not now, in a few minutes, and I'm going to show you exactly how you go about using that, okay? But before we get into it, if you haven't subscribed already, please make sure that you are subscribed to the channel. So hit that subscribe button and also hit the bell so that you get a notification as and when I release a new video. So what exactly is the ATR and how is it going to help us? Well, whether you trade the Forex markets, the stock markets, the commodity markets, literally any type of market, you can even apply this to things like cryptocurrencies, you're going to find that the markets tend to have their own characteristics. And what I mean by that is that they will have a particular range that they average, on average, that they trade in within a particular day. And when I refer to range, I'm referring to the high point to the low point of the day. So for example, if you look at something like the euro dollar, that's typically somewhere between 80 to 100 pips in a day. If you look at the pound dollar, that's a little bit more. So you could be looking at 90 to 100, 110 pips in a day. But what we need to pay attention to here is that the markets do on average only trade that in a particular day. So how's that going to help you? Well, if we know that that particular market or the currency pair, whatever it is you're trading, trades in a certain range a day, and obviously I'm not saying that every day, so there will be some days that it exceeds that range. There will be some days when it doesn't go as far as the range, but on average it goes for that particular range a day. Well, if we know that, then we can actually start filtering out trades that we shouldn't be taking. So imagine that you were trading, let's say, in the middle of the afternoon in the UK. Okay, so we're going to the middle of the afternoon, which is the beginning of the US session, and then we're coming towards the end of that afternoon. So we're going towards lunchtime in the US session, and you get a trade, okay? And you get a trade, and let's imagine it's the euro dollar. And again, you can apply this to stocks. So you could be trading Apple, you could be trading gold, whatever. I'm just going to use the euro dollar as an example. So let's say we're trading the euro dollar and we get an entry to sell the market, and the market's already moved, let's say 70 pips in the day. Well, even though your system may be saying to sell the market, okay, and everything about your strategy says that you should be selling, if you look at the average true range and you see that on average, the market doesn't really tend to move that much further, well, then actually you can say, well, even though my system says to get involved in this trade, actually the market has already gone, towards the end of its range for the day. So therefore I shouldn't be trading it. Okay. And one of the rules that I like to look at is, I say, roughly 70% of the range. So if I'm looking to get involved in a trade and the market's already moved 70% of the range for the day, then I probably won't take that trade. And in fact, what I will start doing is looking for opportunities to kind of reverse the trade. So if the market's been selling off in a day, then I'll be looking for opportunities to buy. If the market had been rallying for that day and it's getting or it's exceeding 70% of its average range, then I will be looking to sell. Okay, and I know that this is kind of a little bit confusing, but I just really want you to understand that the foundations, and then in a second we'll jump across to some charts so that I can really show you how this works in the live markets, all right? But what you need to know right now is that first of all, there is an indicator, so a freely available indicator that you'll get with all charting packages. It's called the average true range. And if you apply that to your chart, to the daily chart, you'll get the average daily range for the particular market or currency pair that you're trading. Once you have that, you then have to work out roughly what 70% is of that range. And then once you know what 70% is, once the market exceeds 70% of the range, you have to kind of err on the side of caution when it comes to entering into a trade. And if you don't want to do that, then actually what you can do is look to reverse a trade instead. So, if you do want to be in the markets once it's exceeded 70%, don't go with the trend for that day, but actually look to reverse the trend. So fade the trend in that day. And actually you'll find that you'll have a lot more success doing that, because even though there will be days when the market does completely exceed the range, the majority of the time when it gets there, it will start either moving sideways or it will reverse the price action for the day. Okay. So with that being said, let's jump over to the charts right now and let's take a look at exactly what it is that I'm talking about. Right, so the chart you have in front of you is the euro dollar. But as I said earlier, it really doesn't matter whether this be the euro dollar, the pound dollar, whether it be Apple, Amazon, gold, oil, it really doesn't matter, because ultimately what I'm about to show you here, the principles apply to all of them. Every single instrument or asset class you're going to trade is going to have an average range that it will trade throughout the day. And as I'm about to show you here, when it gets towards the end of that range, you'll see that the markets typically tend to turn around. Not always. There are going to be some higher volatility days where the markets just completely break through their ranges. But a lot of the time you will see that ultimately when it gets towards the end of its range, when it gets to sort of like the peak of its range, or within, I like to say pretty much above 70%. So let's say, for example, the range was 100 from the low to the high of the day. When the market starts approaching, let's say 70 and above 70, that's where typically I'd be looking for the market to turn around. And there are a few ways that you can play this. So the first is you could decide to use that as some sort of a profit target. So when the market gets towards the range for the day, then you'd look to exit your position. But what other traders do, and one of the things that I like to do if I'm day trading, is I'd like to use the average true range. And when it gets towards, the extended parts of that range, I look to trade reversals at those particular areas of the chart. And I'll show you exactly how that works in just a second. But before we do that, what I want you to pay attention to is the indicator itself. So how do we get this on our charts? Well, I'm using TradingView, and using TradingView, if you go up to indicators over here and you click on indicators, what you have to type, so you can either type in average true range, which is the name of the indicator, or you can simply type in ATR and it will bring it up. And it brings up the built-in one, and it brings up other weird and wonderful versions of it. But ultimately, we aren't really interested in that. We just need the average true range, because all we're looking for is, the absolute number. We're not looking for any derivative of that. I don't know what some of these other indicators are here, but we just want the basic version. Now when I select that will then apply it to the chart. But as you can see down here, I've already got it applied. I apply it to the daily chart. Okay, so I'm not going to apply it to the lower term timeframes, because I'm not really interested in what the ranges are for the lower timeframes, although I'm sure some people out there use it and they find it interesting. They find it useful rather. But from my perspective, really, I'm going to look at it from the daily perspective, okay? Because I want to know what is the range from a daily perspective. Now, the number that you're going to put in here, so if I go to settings, look down in the left-hand corner here, it says ATR. If I click on settings over here, you can see that I can define the length. I can actually also define the resolution. So I could, in theory, have the daily ATR on the 10-minute chart, but I don't do that. I like to look at the daily charts anyway. Okay, so I apply it to the daily chart here. The length it comes in is, as standard, it's 14. However, sometimes I've had it more than 14. Sometimes I've had it less. In light of the recent sort of like volatility that we've had off the back of the COVID-19 pandemic, I wanted to have a little bit of a shorter time frame in terms of the periods that we're going to look back at. So rather than looking back at 14 days, or 14 periods, and obviously this is the daily chart here. I'm just looking back at 10, and that's because I want it to be a little bit more sensitive at the moment, because we had that big bout of volatility, which is really not artificial volatility, but it's not something you expect every day, and that obviously pushed the whole chart out of whack. From that perspective, I just want it to come in a little bit quicker here. So I've got it on 10 for the moment, but when we're in normal trading conditions, 14, 20, that's absolutely fine too. Okay, so got it in at 10 there. The way that it is showing here, I like it. I forget what the style is called. So look at the style here. I like it having the area. You could select line, you can select columns, you could select a histogram. It's completely up to you, but I like the area. It just gives me a nice visual representation down here. Now, in terms of reading the indicator itself, what we're interested in is this number on the right here. So you can see the number is going up and down, and that's just basically displaying the pips, and that's the average pips for the last 10 days. So what it will do is it look at the last 10 days, it will look at the high to the low over the last 10 days, add them all together, divide them up, and basically give you the average for each day. And what we can see is, generally speaking here on the euro, it's roughly about 80. Okay, so there are some points where it's 96, and there are some points where it goes a little bit below 80, so 76, but you can say it's in and around 80. Now, let's go over, now that we know that it's 80, okay, or 80 to 90, let's jump across to the shorter term time frame. So I'm going to zoom in on this chart over here. I've got the 10-minute chart up, and I think that kind of gives us a good resolution. You can see that on the left hand corner here and the right hand we've got the session line. So I've got that in there to show you what a day is. I don't usually have these on my charts, but you can have them in there just to kind of display what the day is. But when you are trading short term, you know where the day starts and where it begins. Now, let's just, before we look into the techniques, let's look at the high to the lows. Okay, let's do a bit of measuring here, see if this actually works. So this is 9th of July. If we go from the high there and we drag that down towards the low, I mean, I could go to the end of the session, but let's just go to the momentum low here. What's that? That's 85 pips, right? 85 pips, and it stops and starts to go sideways. Let's take a look at this one over here. So if we go in here and I go from the low up to the high, that's 70 pips. That was Friday. We can see that that was 70 pips there. Let's go back and let's kind of look at a few others of these. So come in here from the low up towards the high, and we can see that that's 89 pips. We've had a 70, we've had two 90s. If we have a look here from the high going down to the low, we can see that that's 73. So the average figure between sort of like 70, 80, 90 is about right. Now, how do we play this? Well, what you can do, first of all, is you could use it as a target area. So you could say that if you were in a particular trade, let's imagine that you took a break of this low over here, and let's imagine that you were, you're just sort of following the momentum. So you didn't necessarily have any target area, you're following the momentum. Well, by using the average true range and saying roughly 70 to 80% is where I would start to look for the markets to turn around, what you can do is you can use that as a target. So you can say, okay, so roughly, so that's 73 pips, right? And we know the average true range from looking at it just now is about 80. So you're saying roughly about 50, 60 pips from that high over there is where you really want to be looking to get out. So somewhere around here, okay, is where you potentially would want to get out of your trade. And actually, coincidentally, if we look at that there, that's where the market did pause ever so slightly before it gave that last leg down. So that kind of shows you that the market does pay attention to these sorts of things. It's not directly going to turn around because it's the true range, but that just tends to be the way that the mechanics of the markets work, right? So that's the first thing. So you could use it as a target. Now, if you didn't want to use it as a target, you could then instead, you could use it as an entry area. So you could look to trade reversals when it gets to the extremes. Now, what people, with less experience would do is they would see momentum and they would try and jump on board with the momentum and try and get involved, and sort of like sell towards the lows here thinking, oh, there's loads of momentum, it's going to continue. What the professionals will do is that they will look at the true range and they will say, okay, now it's getting towards the true range. So as I said, 70% and above. So if your true range is 80, you're looking somewhere around, 55, 60 pips of a range. You would then start looking for reversal patterns. So we can see that the market comes down to the lows here. what we would then do is we would say, okay, so now we're coming towards that area. And remember that FX has no central exchange, right? So you are looking in terms of area as opposed to being pip perfect. When I get some sort of a reversal in and around this sort of area here, I would then look to react to that. And that's exactly what we got there. So the markets came down, we had lots of momentum. The markets then started to print some indecision candles there. You know, you got some spinning tops, some dojis. What you could then do is say, okay, well, if the market then breaks out of this little cluster to the upside, you would then trade the reversal. You trade the reversal and sure enough, you know, the market goes up. It's not going to do that every time. Sometimes it'll break a little bit lower. But remember, we're not just trading the reversal because it's at the level. You're also waiting for price action to confirm that the market is paying attention to it. Okay, and this happens all over the chart. So let's say, for example, let's go take a look at this area over here. So let's get the ruler in, and we can see that from the high there down towards the low. So we said, so 55, 60 pips, we're starting to look for reversals, right? So the market has obviously exceeded that. It's gone actually to the extreme of the daily range, so 77 pips there. Then you would start looking for some sort of a reversal. There isn't actually any real reversal pattern here, but if there was, you would then look to trade it. And certainly if you were selling there, you would look to exit your trade from that particular position, okay? And this happens again and again and again. I mean, if we look over here, we take a look at this. So the market started here. It then had a massive sell-off. After that massive sell-off, we can see that towards the end here, it comes down to 60 pips. So again, roughly above that 70% sort of level, this is where you would start looking for some sort of a reversal pattern in and around this area sort of here. This is exactly where you get it. Then you sort of insert your favorite strategy as to how you want to trade that reversal, whether it be price action, whether you have a different way of doing it, you know, that's absolutely fine. That's completely up to you. What I'm trying to show you here is how you can use the average true range to your advantage. We're using the euro dollar chart. You could be applying this to your favorite stock, to a commodity, to an index. It really doesn't matter. These concepts are universal and they apply across the board. So there you have it. That's the average true range and how you can apply it to your day trading. And the truth of the matter is that, you know, that's not the only thing that can improve your trading. There are a number of things, you know, past just the system itself that you should be looking at to improve, to really get to the point where you're going to be consistently profitable day trading any sort of financial market. You know, this is obviously the first step. I'll put up some videos with other tips and tricks that you can look at to make you a better trader. But, you know, what you really sort of need to take into account and think about is the fact that trading isn't just about the system. There's a whole lot of other stuff that goes around it. And what you need to do to be a successful trader and consistently successful trader is really start to put the market into context. So take a little bit of a step back. Don't get so close to the markets and look at everything else that's going on. So take every single clue that you can to build a case for your trade. And if everything marries up, take the trade. If it doesn't, don't take the trade. I'm not saying that you're going to avoid losses by doing this. You're absolutely still going to have losses. But what this will do is increase your strike rate. And if it increases your strike rate, it's obviously going to increase your profitability. Okay, so if you like this video, please make sure that you're subscribed to the channel and you hit the bell so you get notified when I release other videos like this, because I've got a whole plan for a bunch of other sort of like day trading tips I want to release to you guys all in a bit to help you improve your trading. So make sure you're subscribed, hit the bell, and I will catch you on the next video. Take care now.